2025 is coming to a close. The tech sector has had a phenomenal year. The S&P 500 overall has had a phenomenal year. We're going to look at Oracle. We're going to compare it to some of its competitors because this may be an opportunity for us in the market. We see here in the past month, the most beaten down stock is Oracle, down almost 20%. And in that same time period, Adobe is up 7%. We can see that the S&P 500, VU, QQQ, SAP, and Microsoft are kind of in the same ballpark. Microsoft is second to last at almost 6% down. If we zoom out to 3 months, we see kind of the same picture. The QQQ, the NASDAQ, is in the lead at a little over 5%, and Oracle down 38%. Everybody else sort of holding the middle in between there. If we go to 6 months, we see the NASDAQ up 15.5%, with SAP down 18%. So just going from 1 to 3 to 6 months, we can see that it really matters when you buy these companies. If you can get in at the right time, you'll be that much better off. If we go to the full year, we can see that the NASDAQ is up about 16%. The S&P 500 is up about 13.6%, and Adobe is down 35%. Now, Oracle, the stock that's been beaten down in the past month, we see that overall this past year, it's been up 7.44%. So again, it's not what you buy, it's when you buy it, but also it's what you buy as well. We want to make sure that we are buying quality companies in our portfolios. If we zoom out to 5 years, we can see indeed Oracle is the winner. Oracle is up 236% in the past 5 years. That is way, way, way beating the market, which is up 100% in that time. The NASDAQ is up about 110%. And Adobe in the past 5 years, if you invested in Adobe 5 years ago, you would be down 25% on your investment. So which of these opens up an opportunity for us in our portfolios to capitalize in the software space? So you might be wondering, why are we talking about Adobe and Microsoft when we're talking about Oracle? Well, they're all in the technology sector and they're all in the software type of business. Okay, so what we've done here is we've measured our growth metrics. We've looked at all the different metrics that we care about when it comes to growth companies: their PEG ratio, their forward PE ratio, their debt to equity, return on equity, return on invested capital, profit margins, 5-year expected revenue growth, annualized EPS growth for the 5 years, annualized free cash flow yield, and forward PE for 5 years. Now we can see these highlighted bold-faced metrics are kind of scattered all over the place. There's not one real clear winner when it comes to just looking at numbers, except for Adobe. Adobe's got 1, 2, 3, 4, 5 numbers that are in the best of the numbers of the 8 companies that we're comparing here. They have fantastic forward PE at 14.31. Their return on invested capital is at a whopping 34%. The profit margin is a very healthy 30%. Their free cash flow yield is 6.44%. And again, what we're really liking these days is the forward PE for the next 5 years. So if you buy Adobe today at its current price, it's like getting it at an 11 forward PE in 5 years. Now, why do we care about that? Technology is usually in the 30s to maybe lower 40s on average for their PE ratio. So this is saying if you buy Adobe now, you're getting it at an 11 PE. That is phenomenal. Same thing with Oracle and SAP, right? Those are the best 5-year forward PEs at just under 10. And everything else is kind of sort of scattered here. So what we've done is we've sorted these by their score. So the top score is Adobe at 7, Microsoft at 6.5, and SAP at 6. These scores again range between -10 and +10. -10 is an absolute garbage company. Don't even look at it. +10 would be the perfect company. So we like numbers that are 5 and above. So 1 through 4.5, we're really not too interested. And we do see that the beaten down Oracle is still ranking quite low on our scores. The only thing it really has going for it is 18% revenue growth. That's nothing to sneeze at when it comes to 26.49% 5-year EPS growth, but we can do better with SAP and WDAY Workday. But there are clear winners here. We have Adobe, Microsoft, and SAP coming in first, second, and third place. Now, 2 of those companies offer dividends. Microsoft and SAP offer dividends, and so we look at their safety scores as well. None of these is really a safety play, but we also look at the scores that are important to us as safety scores, such as their PE ratio, their debt to equity, their return on invested capital, return on assets, their dividend yield. And we can see SAP has a 2.17% dividend yield, Microsoft 0.5%, Salesforce 0.75%. But these numbers aren't really impressing us either, except for, once again, Adobe, Microsoft, and SAP. So what we're going to do is look at those three companies and see what's the best buy in those three companies. So we have our summary here. So we have growth scores of 7 and 7.1 for Adobe, growth score of 6.5, safety of 5.7, and SAP has a growth score of 6 and the lowest safety score of these three at 5. And so we're going to average them. Now, what we've also done is computed their intrinsic values. And for these companies, we've done two different intrinsic values for two of them. Okay, so Adobe does not offer a dividend. They do not pay out a dividend. But what we did do is we used the PE multiples intrinsic value calculator for SAP and for Microsoft. And we also did the dividend discount model. So the link is in the description below on how to do this valuation model and the dividend discount model step by step in Google Sheets. So I will link that in the description below. These are tools that every investor needs to have in their toolbox. And we had a bonus on that video for the PE multiples because we also computed the 10-year forward PE for each company. So for SAP, for example, their earnings per share is $7.08. Their current price is $244 with a PE of 34.57. That PE ratio is not too terribly high, but when we look at the 10-year forward PE, that is sitting at a 13.33. So quite attractive. Now, SAP, when I looked up these numbers, SAP had an expected annualized 5-year EPS growth of something like in the 40s. And I think if we put 40 in here, it's just astronomical. It's saying that SAP is currently $244, but it's in the over $1,000 range. And remember, we like to be very careful, cautious, and conservative in our growth estimates. And so for SAP, we're putting in a 20% EPS growth for the next 5 years. And then after that, we're cutting it in half with our scale down factor of 0.5. So years 6 through 10, we're getting half of 20%, which is 10%. Terminal rate 3%, discount rate 8%, which is pretty standard. And we get an intrinsic value of $375.31. That is higher than our $244.83. And so that gives us a margin of safety for SAP of 34.8%. Now, when it comes to the dividend discount model, we see that their dividend growth rate year over year is about 7.5%. As a matter of fact, I think when I looked it up, it was somewhere over 10%. So again, we're being a little bit more cautious, a little bit more conservative, and we're going to call it 7.5%. The current dividend is $1.91. And so according to our dividend discount model, we get a current intrinsic value of $410.65, giving us with a margin of safety of 40.4% at the current price of $244. So we did the same thing for Microsoft. We said Microsoft in here. Microsoft has earnings per share of $14.06 at a current price of $4.78 with a PE ratio of a little over 34. Now, what we assumed was that Microsoft for the next 5 years was going to have an EPS growth of about 17%, and then half of that years 6 through 10. So that gives us a margin of safety of about 23.5%. Remember, we like margins of safety above 20%, so that certainly qualifies. If we were a little bit more cautious and conservative and call it 16% growth, then that's going to bring us just under the 20% margin of safety mark at 18.9%. And then we do Adobe. This is the only one that does not have a dividend of these three. And with Adobe, we are assuming a 14% EPS growth. And so at their current PE ratio of 21.35, we get a margin of safety of 42.8%, intrinsic value of $623. So you can also see that Adobe has a 10-year projected forward PE ratio of 10.85. So you're currently getting it at a PE of 21, which is phenomenal in the tech sector, and you're getting it for about half that in 10 years. So definitely some promise there in Adobe. So if we go back to our analysis sheet, with these growth and safety scores, the average score, the intrinsic value, their current price, we get all three coming in at margins of safety above 20%, which is what we like. And so we would invest according to these numbers. And again, nothing on this channel is financial advice. I'm not telling you to buy these three companies. I'm not telling you to sell anything in your portfolio. This is just for entertainment and research purposes. So if we wanted to invest $100, since all three of these in our portfolio would be a buy, we would do $40 in Adobe, $26 in Microsoft, SAP $34. And you can also convert these to percentages since we're doing it out of $100. So in our Inner Flame portfolio, if we were to invest in these three companies right now, we would probably do, based on our research, 40% in Adobe, 26% in Microsoft, and 34% in SAP. So that is our analysis. That's what we figured out for these three companies. Oracle, not really a buy right now. It's been beaten down. We feel like it has a lot more space to go down before we would even consider holding this in our portfolio. They need to work on their metrics. They need to work on their fundamentals before we really start to see those higher scores that would make us consider having this in our portfolio. So before we go, I just wanted to point out that Oracle is a dividend-paying stock. Their growth score is not above 5 like we want, but it's pretty close. Their safety score is not very good at all. It's 0.7. Their average score, therefore, is 2.35. So again, Oracle needs to work on their numbers, their fundamentals. But if you absolutely had to start a position in Oracle, it's been beaten down, maybe you feel like the bottom is in and there's room to grow, we would see an intrinsic value of $464 using our two different models. Again, they are a dividend-paying company. They're paying, let's see, their current dividend is $2 per share, so not too bad for a company that's priced at a little under 200. So it's a little over a 1% dividend yield. Their current price is $190, and so that does give us, with the PE multiples model and the dividend discount model, that does give us a margin of safety of 59%, which is pretty attractive. What's bringing down their score in the weighting is the fact that their average score is 2.35. So we have a fantastic, healthy-looking margin of safety, but there is a lot of risk built into this position. And so we may want to cautiously go into Oracle, if you had to, at 16. Again, at Inner Flame Research and Finance, we typically don't move into positions with scores under 5. And so this would be a hold in our portfolio for now. But if you absolutely had to and you wanted to invest $100, 34% go into Adobe, 22% to Microsoft, 29% into SAP, and 16% into Oracle. So like and subscribe if you got anything out of this. I'd really appreciate it. We're growing this channel out. Comment below if you have any sectors, any particular companies that you'd like us to analyze and look through. We'd be more than happy to do that. We're always looking for ideas of things to look at. Oracle came up on our radar as something that's been beaten down. It's on its way down. Is there an opportunity here? We feel like once they get their numbers a little bit more reasonable, and or if the stock price comes down a lot more, then we might be interested in opening up a position in Oracle. But for now, Adobe, Microsoft, and SAP look like better buys for the software space in the technology sector. So thanks for watching. Like and subscribe. Appreciate you, and we'll see you on the next one.